The second quarter revealed a flight to quality as investors reacted to a glut of economic and political data. In the spotlight were evolving trade tensions, tepid inflation, geopolitical tension, and the Federal Reserve acknowledging the potential for rate cuts this year. The United States Treasury curve moved markedly lower in the quarter. The two-year part of the curve saw the biggest shift downward as the Fed communicated its willingness to lower rates soon to support the current expansion. The long end of the curve didn't move as much, as potential economic growth could stabilize a recent slowdown in inflation. However, even with the recent rally, the yield on 3-month Treasury bills remains above the yield on the 10-year Treasury. This inversion of the yield curve started in the fourth quarter and indicates a concern for potential economic or market turmoil in the near future. Even with the warning signs from the Treasury curve inversion, investment-grade corporate bonds continued their rally from the year-end swoon, with yields falling and returns outpacing those of Treasuries, munis, and high-yield bonds. This, along with good performance of high-yield bonds, somewhat contradicted the warning signs of the inverted yield curve. If the Fed is successful in supporting the continued economic growth, we expect investment-grade and high-yield corporate bonds to perform well in this low-rate environment. Strong investor demand for munis, both from institutional and high-net-worth individuals, continued throughout the second quarter. A lack of new issue supply, combined with a large amount of maturing debt, helped improve the positive technical strength for the municipal market. Overall, tax-free municipal yields fell by 27 basis points in the 10-year maturity range, while long 20-year maturities fell by 35 basis points. Looking into the third quarter, we can expect continued volatility in the bond market. As uncertainty has increased, investors have sought out fixed income to reduce the risk in their portfolios. We see this trend continuing. Other countries have slowing economies and central banks cutting rates, making the U.S. market an attractive safe haven, offering positive long-term yields. However, market expectations of Fed rate cuts are markedly different than the Fed Policy Committee's communications on rate cuts. This reconciliation could pressure short-term rates, especially if trade and economic clouds lift. Investment-grade corporate bonds remain attractive relative to Treasuries and are better positioned should the Fed disappoint the market on potential rate cuts. Munis remain attractive as demand continues to outstrip supply, and after-tax yields remain competitive compared to corporate after-tax yields. We expect economic data to be good, not great. The labor market and inflation will be the stars of the show. Inflation may pick up following tariffs and continued economic strength. Let's take a moment to review a key investment concept that we use regularly. Inflation measures the fall of the purchasing power of money. One cause can be the increase in the money supply by the Fed to support economic growth. Wage increases can also cause inflation as people have more money to spend, driving up prices. There are other sources of inflation, but for fixed income, it's important to know that money we are going to receive in the future is going to be worth less. For instance, if we buy a 10-year Treasury at 2% and inflation averages below 2% for the 10-year period, we will have a positive real return after inflation. If not, our dollars, while returned to us with interest, are worth less, giving us a negative real return after inflation. So if expectations are for higher future inflation, long-term interest rates might rise as investors want to get positive real returns. For more information, contact Ross Sinclaire Asset Management or visit our website linked below. Thank you for joining me for this quarterly update.